Hi, everyone, and welcome to the latest episode of Coinscrum. My name is Bendiksen, and I'm the head of research at CoinShares, Europe's largest digital asset manager and home to the legendary XBT provider, Bitcoin exchange-traded certificates. In today's episode, we have a Bitcoin halving special on mining economics, and to cover that topic in the sexiest detail possible, I have two excellent and distinguished guests with me today. Pavel Moravec, who is the co-CEO of Brain's SlushPool, and Dr. Philipp Kallerhoff, who is the CEO of Protos Asset Management. Welcome, guys.
Hi, everybody. Thanks for having us.
So before we get into our excellent list of topics, why don't you both give us just a quick bio explaining how you ended up on the show today, and we can start with Pavel.
Yeah, I'm here probably because we are running as a company SlushPool, which is the first mining pool in the world for, let's say, we do it 7 years already. So we have some in-field experience with mining, and halving is about mining. So this is the reason why I ended up here, obviously.
Excellent.
Yeah, so my name is Philipp Kallerhoff, and I am the CEO and CIO of Protos Asset Management. We are running crypto hedge funds. We've done one of the first tokenized security token hedge funds in the US in 2017. And we have been running crypto trading strategies since then. And we have one of our major clients are mining firms, and we are operating for them difficulty swaps as well as Bitcoin hedging strategies. So kind of locking in certain yields coming from mining from that.
Cool. Excellent. So why don't we start with just a little bit of a comparison of the current landscape versus the last halving. So it's been 4 years since the last halving. Pavel, how would you say that the mining industry landscape has changed since then?
I think the biggest difference is size of miners. We could see a large shift towards bigger and more professionalized miners. The tendency was visible even before, but the last 4 years, it's very significant shift towards industrialized miners, like big companies, publicly traded companies. Yeah, this is the biggest shift, I would say. More sophistication on all levels, every single detail, and the whole process of mining as more detail is scrutinized and tried to be as efficient as possible. And this process is continuing. And yeah.
Yeah, and on the hardware level, right around the last halving is actually when the venerable Antminer S9 was released, and I think we can say that it served those who got into the mining space around then pretty well. And so right now we have the S19s, we have the M30s being released. Do you guys think they will offer the same kind of risk moderation to new entrants now as the S9 did back then?
Yeah, I would say we can basically expect the similar thing with the new generation of hardware. Just a quick note, S9s are still profitable after halving if the price is on 9K level roughly, and the difficulty is not going up very, very fast. But it's really edgy thing. But we can expect that the new hardware will completely replace the S9s and do similar stuff, because like nobody expects huge improvements in mining efficiency as we could see last years. So yeah, I would say it's very similar situation.
I mean, from maybe just jumping in there. So since we have kind of advised a lot of miners, and we have advised public mining companies, obviously, with very, hundreds of thousands of rigs. And of course, like you said, right, with the S9 machines, they had a huge bull run that kind of turned over, of course, in 2018 when Bitcoin dropped, and they all became partially unprofitable back then already. Then they came back in 19, and now with the new machines, obviously, there's a new generation. So that's super interesting. But I think what we have to keep in mind is that they were extremely profitable because the Bitcoin price rallied after the last halvening, and that obviously had the big impact on profitability not if we assume that the Bitcoin price would have stayed the same, then of course that profitability would have been way different.
And do you guys think those two play into each other?
Pardon?
Do you think the profitability of mining plays into the Bitcoin price in any way? I know Matt D'Souza has been very forward about this concept lately. And to give viewers like a quick recap of his argument, he essentially says that when mining profitability is excellent, fewer coins end up hitting the market, which constricts the ongoing supply further, which tends to create a virtuous cycle and feed into any ongoing or budding bull market that we have happening at the same time. How do you guys feel about that theory?
Yeah, I mean, I know Matt quite well. He was at our conference in January here in Zurich. I've just chatted with him just this week about another difficulty hedging over the halving. And I really like his argument. The question, of course, and that's a great argument. I think that is partly true, at least for the miners that we work for. That of course they take more market exposure if they don't have to sell all the coins to kind of keep the company running. On the other hand, I think we will see a massive, well, the halving is going to happen, and you will produce only half the coins. So therefore, their profitability will drop unless Bitcoin, like you said, right, will go to 9,500, and then they will have some flexibility. But overall, I think they have now more free coins, of course, than they will have next week, right? So already that, I think, will have an impact, and they will, obviously they will sell the coin. They have to sell more the coins that they get. Total volume, of course, will just be half, right? So that's the counter argument.
Mm-hmm. Yeah, I think the theory is sound, but it is a big question how significant the pressure is. If stuck-to-flow theory works as people would like to work, then exactly this mechanism of selling more or keeping more from miners would lead to exactly the same behavior on the markets. Because the halving would be very similar to just keeping half of the coins and not putting them on the market from miners' perspective. So these two theories either both work and have significant impact on the price or not. And I don't know what's the case, but yeah.
Yeah, I mean, so the stock to flow. I mean, okay, you want to jump in? Yeah, sorry.
No, go ahead.
No, I mean, the stock to flow ratio, I've been following obviously also quite a bit, and it's quite famous. My big, I'm a data scientist coming from a PhD in computer science, is that, there are only 4 data points. I'm really sorry to say that. And the 4 data points are, the different halvings. That's fair enough, right? But at the same time, does that really have any reason to kind of, to follow the future? And look at Bitcoin Cash, right? I think it's a good example. They had the halving, and yes, you can say, and difficulty dropped massively, and the Bitcoin Cash price as well. And now, of course, you can argue, okay, that is a different asset, not as well cared for maybe as Bitcoin, but still, we'll really see it. This is going to be really interesting.
So just adding some quick color to that, a couple of weeks ago, I checked what the average daily inflows into passive products like Grayscale's and Bitcoin Investment Trust and our own CoinShares XBT provider product plus Cash App. And in Q1, I estimate that there is around 750 coins flowing into those products every day. Now at 1,800 coins like daily issuance, obviously there's a big gap between the two, but at 900, all of a sudden we're nearing 85% of ongoing issuance just being eaten by these inflows. So I just think it's an interesting argument to put up on the side of the stock to flow modeling and an interesting way of thinking about what could potentially happen when you have this type of supply constriction.
Yeah, but because people don't see the ratio of coins put directly to the markets from miners. Right now, it can be different number, very different number than what it's going to be after halving. And so even if the theory works, then we don't have this number to put into the theory, because it doesn't matter how much coins you produce. but it's driven by how much coins you are selling, and it's not, at least to me, it's not clearly visible what the number is. You have the insight better, but
I agree. And no one, I think, has that fully visible. All you can do is do as solid of an estimate as you can. I don't know if you guys saw the data that came out from Coinmetrics the other day, where they used analysis of the non-space that the S9s and the S7s apparently go for, to try and get an idea of their proportion of hash rate in the overall market. I thought that was a very interesting and data-driven approach to it. So for those who haven't looked that up, you should check it out. So let's talk briefly about edges, because I'm realizing we're actually quickly running out of time here, and I just feel like we're only just getting into things, just into interesting stuff. The way I see it, there are two interesting avenues for edge going forward. One of them being access to capital and financing, and the other one being firmware optimization. And I know that both of these are respective points of specialization. So why don't we ask very quickly, Pavel, how do you think there's more edge to be gotten in the overall market from firmware optimization, or do you think we're getting to the edge there too?
There's still a lot of space in this era, I would say. This is one of the last pieces of the whole like mining ecosystem, which needs to be professionalized more. We are trying to do that. And let's look at the S9s. You can, by running different versions of firmware, you can get, let's say, 20% of hash rate output from the machine just by running different firmware and doing all the proper setup from the hardware perspective. And this is too large to not being used by miners. And this is going to happen for S17s, S19s, all the machines out there. The manufacturers are not using the hardware, or their firmware is not using the hardware on the very edge. And it kind of depends on various miners' risk, how they feel about risking the hardware and pushing the hardware to very limits. There is certainly a risk by running more efficient firmware or overclocking the hardware. Yeah, but there is still a large space, much larger than in any other single point I can imagine right now. With hardware you can get. Because you're obviously dependent on the hardware manufacturers, what they can bring to the market. And if it's going to be 20% better, great. But you as a miner cannot change this. You're just waiting. But firmware optimizations are something what you can do yourself if you dig deep enough.
Yeah, I mean, I think I totally agree with that. And the only issue I see with the mining firms is that, of course, they are running out of time, right? So even, like, yes, of course, it would be nice if you would have the time of 24 months to get the money back for your machine. But the way it went the last at least 4 years, it went down from 24 months to 18 to 12. And now you're lucky if you get 9 to 12 months out of this machine. So my feeling is you probably want to overclock as much as you can, because you might just have to risk it, right? You just have to risk it and get the Bitcoins as fast as you can. And of course, that again drives up the difficulty again. So you kind of killing your own market, but that's what the miners are facing.
Yeah, this is exactly the competition miners are facing all the time. So if competition is overclocking, you're directly forced to do it yourself as well, because otherwise you are in competitive disadvantage. So if there is a space for running more or getting more hashes from the same hardware for the same investment, you should do it. As a miner, the incentive is pretty clear. So yeah, completely agree.
And then, of course, there's the constant competition in the reinvestment cycle, which again drives up difficulty, which again drives miners to have to reinvest in more efficient hardware, especially if you're sitting at the bit of the higher end of the electricity cost curve. And over the last few years, we've seen a proliferation of financial products for miners that allow them to access capital in different ways than before. Philipp, maybe you can speak a little bit about this. Is this all positive, or does it also introduce some vulnerabilities in the structure of the market?
For sure, right? I mean, so we've worked on multiple deals, helping company to list equity, right, in London and Canada, and that went really well in 18, 19. And you know the examples that were listed, and I think that capital was extremely good for these companies because it was equity driven. You have financial markets, so they can always issue new paper, and so they have access to these markets, and that makes it very hard to compete for other players. The second thing is what we have worked on is debt financing. Debt financing is extremely interesting because if you think about it, that you have machines that are 50% profitable, right? Why wouldn't you leverage your current infrastructure with a bit of debt, right? And you pay maybe 5 or 10% even, right? But with 50% profitability, that should be easily doable. Problem, of course, is that again, if your profitability goes down so fast, like it did in the last 24 months in multiple cycles, that you had only 9 to 12 months really to get. Well, you thought you have 18 months to get your money back. With a normal appreciation of difficulty, you made your model. And yesterday, Coinmetrics came out with another index on what they would expect difficulty to change to in 3, 6, 9 months. But the problem is that usually that was always, or in the past, at least in the past 4 years, this was always under the actual numbers. So you were always faced with, I have to get my money back faster than I was expecting. And what happened is we wrote and we helped lending out money to mining companies over 12 months and then 6 months and 3 months, because now everybody got extremely wary of these risks. And so I think it's debt financing is extremely interesting, but only if you can lock in both the Bitcoin price, which you can easily do with the Bitcoin future, but also the difficulty. And Bituda came out yesterday with that they have this first trade. I have to say, sorry guys, we've done it already 12 months ago. We've locked in difficulty levels over a period of time for different mining companies, and that of course is interesting. What we haven't achieved yet though is a contract of 12 months length, right, where you can really say, okay, if I can lock in the difficulty, even if that is 50% above today's level or 100% above today's level, but if you could lock that in and lock in today's Bitcoin price, which and then you can say, I can do a math on, I'm going to produce a certain amount of Bitcoins over these 12 months, let's say 1,000 Bitcoins or 10,000 Bitcoins. And at the same time, I'm taking a short position future position in Bitcoin. I sell these 10,000 Bitcoins at today's Bitcoin price. And then I say, okay, this will make me whatever, $10 million. Then the 10 million, or probably today it's whatever, $9 million. And today, how much do I pay for these machines today? If that is less than 9 million, of course I'm interested, right? Because then I can say, I'm going to lock in 10,000 Bitcoins at $9,000 Bitcoin price. I'm paying right now 8 million. Perfect, right? I'm interested. We haven't achieved that. The longest we've kind of done contracts was 3 months. We're looking at 6 months contracts now. But so this market is only just starting to develop, but I think that could be a big, interesting new development in the crypto space, because that would mean we're now finally able to sell bonds, right? Yield-bearing bonds against these mining companies.
Excellent. And unfortunately, on that note, we're gonna have to wrap this up. Thank you guys very much for coming. And last thing before we leave, what's gonna happen after the halving?
I mean, I think difficulty will drop. Yeah? That is good. But let me just I'll just give you my view, and then Pavel. I think difficulty will drop slightly, but it'll be quickly back up with the S9. Capacity coming in, see a major drop. At the same time, I think 25 to 30% of miners will get washed out. And at the same time, these profitability, like Metasusa, showed in his paper will go up. So I think Bitcoin will appreciate, but it won't appreciate as much as everybody hopes for, right? So I think 10 to 12,000 maybe towards the end of the year, but it's not going to be 20,000 plus.
Yeah, I mostly agree with what you just said. I think it would be very similar to what happened with mining space when the price last dropped 50%. It's gonna have exactly the same impact on the mining space. The difference will be just people will execute their prepared plans because everybody knows about halving. So it's going to be slightly different in this sense, but otherwise it's just price drop from miners' perspective. Yeah. So it's going to happen so many times in the future, even without the halving.
Yeah.
So
it just generally volatility is so high in Bitcoin, right? I mean, if you just compare that to traditional assets, we're calculating the volatility of the top 100 assets, crypto assets all the time. And it's in general 100% volatility. What that means is that the assets double or go to zero with a pretty high probability, right? Over a year. Yeah. So that, so it's a very high vol market.
But
and
don't ever say that Bitcoin is going to go to zero. You'll be so unpopular.
You heard it here first. Statistically, Bitcoin will either double or go to zero this next year.
Yeah.
All right. Thank you guys so much. It's been a pleasure. I wish we had more time, but maybe we can do this again sometime. Yeah. So have an excellent rest of the day to you both.